Thank you for tuning into Astor Investment Management's podcast series. This week, our Chief Investment Officer, John Eckstein, and Senior Managing Director, Mac O'Brien, discuss the current economic outlook in the era of COVID-19. Thank you both for joining us today.
All right, welcome back to another edition of Astor's Economic Week in Review. As always, you have myself, Mac O'Brien, with Astor's CIO, John Eckstein. John, good morning. How are you?
Morning, Mac. How's it going?
Great. So we typically start off with a summary of what we're going to talk about, but we had a huge jobs report this morning. I'm just going to hand you the mic and have you kind of go through some of the data to not be repetitive and redundant about other things we talk about on a normal Friday podcast. John, surprising numbers this morning. Walk us through them.
Yeah, big number this morning. I think, we'll probably spend most of our time talking about the labor market today, and that there's a few other points we should talk about in terms of savings and income, and then also the PMIs and stuff. But the labor market's really the bigger thing. So let's think about the headline payroll numbers. We gained 2.5 million jobs versus losing an expectation of losing 7.5 million jobs. So one, why do we expect a loss of 7.5 million jobs this month? Well, I think that's probably mainly due to the claims numbers, which have continued to increase a lot over the last month. So why may have we gotten, so that, I think that was like the source of that. So is there a disconnect between the claims numbers and the payroll numbers? I'm going to say yes, I think there is. I think there's something that we need to figure out with that. The overall situation, gaining 2.5 million jobs, I think the first thing to think about is that the flows are extremely high on both sides right now, right? Like there's a ton of people losing jobs, ton of people getting jobs back, and it's going to be a mess for a while. And today, we saw a positive number that's actually consistent with some other things that we've seen in terms of, we've talked about some higher frequency numbers, that is numbers that released with less of a lag or released weekly or daily, sort of stabilizing at very low levels. And this number is consistent with that, right? So the headline unemployment number is 13%. If you measure it correctly, according to the BLS, the Bureau of Labor Statistics, who releases the report, measure correctly, the actual unemployment rate is 16%, which is still like way more than the worst of the Great Recession. And if you look at the unemployment rate, that's more like 20%. And that improved a little bit too. That went from like 22% to 21%. What you're seeing is that, where do these job gains come from? Well, these are people who were classified as being on temporary layoff, right? So the 3 million jobs gained are totally explained by the reduction on people on temporary layoff, right? So that's some people who got laid off and are coming and are being recalled to work, right? So you might think about a business which shut down in April. They laid off their 20 employees. And then in May, they're like, oh, we're doing okay delivery business, so we'll bring 7 of the employees back. Like, I think that's roughly the story, because the level, there definitely has been a bounce, right, is what it seems like. But the level of unemployment or underemployment or whatever, however you want to measure it.
What is underemployment at? Did that come out at all?
Right. So the underemployment that's reported in the report, there's various ways to define it, but underemployment went from 22.8% of the workforce to 21.2% of the workforce. So, normally a 1.6% jump would be extremely large, but it's still at high levels. And so underemployment includes people who want more hours. You want to work full-time and now you're working part-time, or people who are marginally attached to the workforce. That is, they're not looking for jobs. And I think that's a good number to look at, right? Because it's hard to look for a job when you're in lockdown.
Right.
My overall take on the report is, one, the most important thing is the numbers are going to be noisy for a while because they're just so big, right? Millions of people losing jobs, millions of people gaining jobs. And people are still definitely losing jobs as far as we can tell from the claims numbers. Two, there is, a bounce or a floor, depending on how you want to describe it. And we've seen that in some of the weekly numbers we talked about, and we see that in this number. You do also see, though, at 3, like, this is mainly the gain is people coming off a temporary layoff, though you actually see a rise in permanent job losers of 1 million compared to where they were in February. So we're going to have to watch the balance of that. And another thing, we've been talked about, trying to bring to people's attention, to look at the state and local government level. And so right now that's 1.3 million below last year's level of employment. And so there's still a lot of difficulty out there, right? And so we'll see how this evolves.
We focus a lot because it's a weekly report and this is a weekly podcast. We focus a lot on jobless claims. And so to give the listeners just an idea of where it is this week, it's around 1.9 million, 1.87. And that's down from 2.5 or 3 if you include pandemic unemployed assistance. Now, what was the PUA number this week on top of the jobless claims? John, do you have that handy?
Yeah, it was another million roughly.
Okay, so we're still at around 2.8 million claims last week. So yeah, there's just a conflicting picture between jobless claims.
And so one thing that could be happening is that we've talked a lot about how, the state claims infrastructure might not be robust enough to handle the volumes, right? So are people claiming again because they got rejected? Are people just finally claiming after a delay? It's hard to...
there could be people claiming right now because they can finally get through the system that already have their job back or getting their job back, right?
Yeah, that's totally possible.
All right.
Totally possible.
Because if you file today, you've been unemployed for the past 3 months, you're going to get unemployment for 3 months. So you still go through the process of filing, even if you're working, because you can still collect your lump sum from March until today, if that's when you were unemployed.
Yeah. And if anybody is in that situation, I encourage you to do that.
Yeah.
And go spend the money, please. Yeah. And again, talking about claims, my reading of the claims number is that there were 20 million people being paid by state unemployment insurance last week, and another 10 million from the PUA. And so that's substantially more than the number of jobs we've lost, right? So that's 30 million in claims versus, 20 million in job losses, basically. It was worth pointing out that when you think about the people who lost jobs a year ago, May 2019's report, that was 2.3 million. Today, it's 17.8 million, right? The number of people who were unemployed. So it's definitely better to be bouncing rather than not. But, I'm really glad that this number is not looking worse. But the idea that we're in a self-sustaining recovery when we still have 17.8 million people unemployed is concerning. And I'm worried that the federal government is going to say mission accomplished and let all the fiscal stimulus expire in July when it's scheduled to.
That is a good point, because I just got a text from a buddy and it was a string of tweets by POTUS, all within 3 or 4 minutes apart, just saying news conference at 10 a.m. What great jobs numbers. It's going to be hard for the Fed to rationalize additional stimulus if they're touting, mission accomplished, so to speak.
Well, the Fed, we need to distinguish between the Fed and the federal government, right? The Fed can do what it wants, basically. The Fed can only loan money. It can't give money, right? The Fed can do some maturity transformation, do some credit transformation, and add liquidity to the system, but it cannot just send us all checks. The federal government is the one, and this might be a good segue into our next topic. The federal government are the ones who can send everybody checks. So let's talk a little bit about savings and income.
Yeah, I was going to talk about that. So yes, personal savings rate. What do we have there in income?
So the savings rate, I'm seeing some journalists saying they're getting instructions from their editors that they can't use the word unprecedented anymore. But I'm not a journalist, so I guess I'm free to say what I want.
I need to pull up the thesaurus, because it's like I get sick of saying it. It's like what's another word we can use besides unprecedented?
Insane, mind-numbing.
Yeah.
So here we go. Right. Listen to the April personal income report. So again, I'm going to emphasize this is April, and that's going to be important in a sec. So bear that in mind. So real disposable personal income for April plus 13.4%, the largest on record. Real personal consumption expenditures minus 13%, the largest on record. Personal savings rate up 20% to 33%, both the highest on record.
Geez. So summary, people made more money at a record pace.
People got more money.
Got more money. Yeah, I'm sorry. Got more money, federal stimulus. They're spending less money at a record pace, and they're saving more money at a record pace.
Yeah. Yeah.
Which is all very bad things for the economy, except for people getting more money.
Yeah. And so income actually went up a little bit in April. Aggregate income, as we're measuring now, went up a little bit in April. And that's mainly driven by the one-time stimulus checks. Those all came out in April, substantially. So actually the Treasury, your tax dollars at work, tells you every day like how much money they're spending on a bunch of different line items. And if you look at May's stimulus disbursements, May disposable personal income will fall by 10% from April's high, even if there's no further wage declines.
So break that all down real quick, John.
People got the stimulus checks in April. Substantially, most people got their stimulus checks in April. It was enough to bring personal income up. People were locked down, so they spent less money. That's the drop in consumption expenditures. So now the big question mark is the rise in personal savings. Was that involuntary because people didn't have any place to spend the money because the mall was closed? Or was it precautionary? And the reality is it's a little bit of both, right?
Yeah,
but
right.
Where does that end up, I think, has a lot to do with our future.
Yeah. I mean, not to pivot, but, we talk about motor vehicle sales, and that was a upside surprise, right?
It was but again, like the story is basically upside surprise and a bad number.
Yeah, right.
Right. But vehicle sales, were a little bit stronger than expected.
I'm not quite sure. I think that a lot of it has to do with not having a lot of things to spend your money on, right? Personally, our personal savings rate is up in my household, and we're still spending money. There's just so much money you can spend when you can't really go places. There's only so much stuff you can buy on Amazon and so much takeout you can get without, going to concerts and ball games and going to the mall and driving to Bye Bye Baby or Best Buy and things of that nature. So
why don't you put an extension on your house, Mac?
Yeah. See you later.
Well, spend your money. Look, you got to get that money. You have to do your part for America, Mac.
Yeah. Okay. Well, hey, man, you can control that. So give me some more money and I'll do it.
Let's talk a little bit about the manufacturing sector, because we thought that would be the first one to bounce back. That's what we saw in China anyway. We do see the rate of decline attenuating, but we don't see sort of an expansion is where we are with the manufacturing, both the manufacturing purchasing manager survey or the services purchasing managers survey. Both of those are still at extremely low levels, but not as low as they are. So again, that's sort of not as low as they were. So I think we've got a bunch of different data coming to the same conclusion, namely that things are bouncing a little bit off the bottom, not getting worse. And the question is how quickly they're going to get better.
Mm-hmm. So all interesting points, and we always say we'll have to wait and see how things play out because it's true. And one thing that we've been watching is the non-manufacturing sector, right? The service side of the economy. That came in pretty much in line with expectations, but still below 50, which is understandable, at around 44, I think. What do you make of that number, John?
Yeah, so there's two different surveys. One of them came out there with the same methodology. 50% is the dividing line. So one came out at 45, one came out at 37, and both of those are off their low. And I think that's consistent with the other stuff we've been talking about, right? Where you're saying that the story for May looks like some modest improvement, but to levels that, were sort of not unimaginable, but before seemed like an extremely difficult situation for the economy to be in. And if we sort of loop through our higher frequency numbers, they look the same, right? So the number of diners that are seated, is up to 80% of where they were before the lockdown, as opposed to down 100%, and showing sort of very modest continual improvement. Same thing with the number of people going through the security checkpoints at airports, right? All the numbers that we've been looking at on a weekly basis are improving now. The retail number of people on the floor of retail establishments, the staffing numbers have bounced a little bit finally. Consumer confidence numbers, everything's pointing in the same direction where things are getting better, and they're still at very challenging levels.
So, John, the employment report is obviously the biggest story of the day. We've talked about that thoroughly. I say that there's the forest. We're in the forest right now looking at, the specific group of trees that deals with COVID, the fallout, which is the jobs report. But outside of that, there's other things that people should be looking at, and I hope they are. And one is the escalating tensions with China. You and I had talked about it, and you have some thoughts, some things to say about that, talking about China and what's happening.
Yeah, so the tricky thing with looking at the U.S.-China situation is that, this is a political decision. So it's not sort of like, oh, we can read the numbers and figure out what's going to happen. So if you look at the phase one trade deal, we're about 50% of the way we were supposed to be right now, right? Not 50% of the purchases that China was supposed to do, but 50% of the way we're supposed to be at this point in the year, right? We're 5 months into the year already. What does that mean? Well, you might say, gosh, there's no way they can get it done, which there was kind of no way they could get it done from the beginning. Like everybody knew that, but the number at the end of the year comes out after the election. So, it doesn't really matter, right? The president can make sort of whatever decision he chooses. And so, if you look at the numbers on China, there's definitely a reason for the president to say, this deal didn't happen, and so we're going to reimpose our tariffs, which the stock market would take badly. But, the stock market reaction is definitely part of his reaction function, right? Like the stock market goes into whatever function he's doing to figure out his actions to take. There's numbers to say this deal is going to fall apart and that would be bad, but there's also it's not just looking at the numbers, it's looking at everything else. So China, we're going to have to be looking at sort of the politics of it, which I'd much rather be looking at the numbers, right? There's actually a definition that somebody uses of emerging markets, which says that emerging markets are basically markets where you have to look at the politics to figure out what's going to happen in the markets, not just the numbers. And so I didn't think we would be in that situation, but here we are.
Yeah. And like we say at Astor, right? Like the probability of recessions, which we're in and hopefully starting to come out of, but the probability of recessions increases when you have a weak economy plus external events, right? That drag the economy down, and escalating tensions with China, amongst other things, could be catalysts to slow down a potential recovery. So, John, thank you for your time today. Listeners, thank you for listening. John, what do we have coming next week?
Next week, honestly, we might talk a little bit more about the about the labor market. We do get the JOLTS number next week, the job openings, and we get another claims number. And people have had a little bit more time to digest the payroll, and we might talk about that a little bit more next week. We get CPI. Interesting, we're going to get the Fed. Things to look at the Fed are going to be not only its interest rate decision, which I think is baked in the cake, but the projections of what they think that rates are going to do. Definitely tune in next week.
All right, everybody. Thank you. Have a fantastic weekend, and we will see you next week.
To learn more about Astor Investment Management's research and strategies, please visit us on the web at www.astoram.com or stay up to date by following us on LinkedIn, Twitter, and our app is also available on the App Store and Google Play. Thank you. Astor Investment Management, LLC is a SEC-registered investment advisor. All information contained herein is for informational purposes only. This is not a solicitation to offer investment advice or services in any state where to do so would be unlawful. Analysis and research are provided for informational purposes only, not for trading or investing purposes. All opinions expressed are as of the date of publication and subject to change. They are not intended as investment recommendations.